Hey Internet, it's RJ. Welcome back. Thanks for tuning into the show today. Now, today's episode, we're talking about credit card interest and APRs. Now, we all know that you're supposed to avoid paying credit card interest at all costs because there's no amount of points that you can earn to offset that interest. However, the problem with that is we tend to just gloss over how interest works, how to calculate, and everything you need to know about it. So that's what we're going to focus on today. So, of course, if that sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. So, of course, when it comes down to it, again, credit cards, this really applies to any loan product, right? We just kind of focus on credit cards here on the channel, but APR, right? That's how you're going to see this number expressed as. So let's start with that. What does an APR stand for? How does this work? Well, on screen you have it. So APR stands for annual percentage rate. So this is the rate you are charged per year for carrying a balance. Now, yes, this is annual, but keep in mind that with credit cards, again, which is our main focus here, credit cards actually compound interest daily. So that balance is always going to be growing. And later in the video, we will show you the math behind it and how that works so you can calculate it for yourself. Now, the real question here is, why do credit cards have such high interest rates? Well, there's a few different reasons. Number one being is that, it's secured versus unsecured debt, right? So if you take a mortgage, for example, you're like, I'm borrowing so much more money, $200,000, $300,000, $400,000, $500,000, whatever it is. But my interest rate, even now, late 2020, 7-8%, something like that. Versus a credit card that's usually 14% plus. Well, the mortgage is, the house acts as collateral, right? Meaning if you don't pay the loan, the bank can come and take the house and recoup much of their loss. Of course, plus the bank also makes you put some money down as well up front versus a credit card where, let's say, they don't know what you're going to buy. So if you buy a sandwich, you eat the sandwich, never pay for the sandwich, they're not going to come and try to take the sandwich. Even if you buy a phone or something, they're really not going to come and take that. It's not really worth their time. So part of it is what they call pricing in risk, right? So to make up for this fact that they don't have any collateral securing the loan or backing the loan, they crank up the interest rate super high to make up for that. Now, the other piece of this is something called credit worthiness. Now, you'll see this word a lot in your credit card terms and conditions and applications. They'll say rates. They'll give a range usually, right? They say your APR can be anywhere from like 14 to like 29%, and where you land on that depends on your credit worthiness. And this is kind of like a nice way of saying like, hey, depending on what your credit score comes back as, that's where we're going to slot you in interest rate wise. So if you're up in the 750s, closer to 800, then you're going to be closer to that 14% rate in this example. However, you're down to the 600s, then you're going to be closer to that 29% example. How worthy are you of the interest rate, which is, again, another way of saying pricing and risk. They have a lot of risk models on their side, things like that. But that's the gist of it, how it works, right? So, that's APRs, but it's not that straightforward per se because there's different types of APRs that you could come across, right? Because making purchases on credit cards is just one aspect of them, but there's still balance transfers, cash advances, promos, things like that. So let's talk about the different types of APRs that you could see represented in your credit card statement or in the terms and conditions or card member agreement. So here we have it. There are a few. So again, purchases, fairly straightforward. That's the APR charged to the purchases made on the card. Again, balance transfers, that's the APR charged to balances transferred from one card to another. Doesn't have to be from a card. You can basically transfer credit balances from other products to a credit card in the debt consolidation move, and there could be a different APR for that. There's penalties, right? So if you're delinquent past 30, 60, or 90 days, they definitely put in a different APR in place for that. Cash advances, again, when you take your credit card to the ATM and actually use it to get physical cash, there's a different APR for that. And then introductory APRs, promotional pricing for opening new accounts. A lot of times new accounts, to get you to use the account, will say, hey, you get 0% APR for the first 12 months on purchases or something like that. So those are your different types. Now, in addition to that, there's one other thing to note here, and that is fixed versus variable. So fixed APRs, again, that means the rate does not change over the life of loan. So again, our mortgage example fits here. So you might have heard your loan product for your home expressed as a 30-year fixed conventional loan or a 15-year fixed conventional loan. That means the life of the loan is 30 years, and that word fixed means that interest rate is not going to change. Now, they do have mortgages that do change to like variable, or they're called ARMs, adjustable rate mortgages, but again, for our example, most people end up with a 15 or 30-year fixed. Auto loans would be the same. Now, variable means exactly that. The rate can change over the life of loan at any time. This is largely based on the federal interest rate changes or issuer adjustments based on credit history or the markets, things like that. And so, of course, as you might have guessed, credit card interest is not fixed. That's going to be variable. That does change quite a bit, or it can change quite a bit. But of course, we're going to talk about it a little bit later, because there are some things that the bank has to make you aware of before they actually just hike the fee on you. They don't necessarily need your approval or agreement to it, but again, they can change the fee, at their own discretion. It's in the card member terms and conditions. That's actually where a lot of this information is about your APRs and things like that. There's a card member agreement, card member terms. That's what you want to look through. They also put your current APR on your credit card statement as well. So those are things to take a look at if you're kind of wondering what yours is. Now, with that, though, how exactly do you calculate this interest yourself? If you wanted to know, hey, if I'm going to carry this balance, what does that actually mean? Well, we're going to pull the math up here in a second to kind of walk you through an example. And so here we have it on screen. Like most of this information, the math formulas are from Value Paying, when I will link their whole article down below. But since they already did the math, I think we can just free to borrow it. So again, they have kind of 3 formulas here, and I'll leave that on screen for a little bit. But again, the best representation of this is going to be able to put this in an example to figure out how much you would pay. So the example they have here for us is, again, straight from their article. Say you have an APR of 15%, a balance of $5,000. So in that case, the average daily interest paid will be, again, the formula right here. And again, you can see how they calculate, but it would be $2.05. And from there, you can multiply that by 30 to find your monthly interest accrued, which would be $61.50. So you can see how that over the course of a month jumped up pretty quick, right? Because again, they're compounding it daily, and that's, to make life a little bit harder. Now, of course, keep in mind, as they say, as we always say, that you won't accrue interest as long as you pay your statement balances in full. And that's going to take us into the next section, because now that we've seen the math, we can definitely see that adds up very quickly. And again, there's no credit card that's going to give you that many points to cover the interest charges that you would carry. So payments here. Obviously, again, there's 2 options. You've probably seen them on your credit card statement before, but you'll see a minimum payment and a pay in full option, or pay like another amount that you can pick. Well, again, as you would have imagined, there's a minimum payment that you have to make. And making that minimum payment simply means that you're not going to be delinquent. It won't count as a missed payment. So normally it's either a percentage of the balance or like $25, usually whichever one is more, I think. So again, if you had a $100 balance and your minimum payment is $25, then you've got to make that minimum payment of $25 each time. Now, that will mean you have made a payment. It will not count as a late payment. But again, you still have $75 that you're going to start accruing interest on. So, you generally want to go with pay the full amount, pay in full. They also let you specify an amount as well, but again, if the amount you specify isn't more than that minimum payment, then that would not count as a full payment, then that would technically be a late or missed payment. Now, however, you do get some time to make this payment. It's actually called the grace period. So if we take a look at this is important to know, because this factors into when interest starts accruing. So the grace period basically is the time between a statement closing and the minimum payment due date. It's usually around 25 days, give or take. Now, if you pay the card balance during this window, you will avoid interest charges altogether. And that's the key here, right? So really what they're saying is, in layman's terms, is, let's just say, you're going to have your credit card statement. It runs for a month, right? So October 1st, October 31st, right? Because you wouldn't technically know your full credit card balance of what you owe for that billing cycle until it closes, right? The close date, October 31st, it takes them usually a day or two to, kind of calculate everything and to technically either send you a bill in the mail or send you an email that says, hey, your statement is due. And then you'd have about 3 weeks, give or take, that grace period to make that payment in full. Now, if you get to that grace period and you haven't made it yet, or you only made the minimum payment, again, from that date forward, that's when interest will start accruing. So that grace period is a big thing. You don't have to keep paying your credit card every single time you use it. Really, you just have to wait till the statement closes. And usually as soon as I get the email, the statement's closed, I go ahead and pay it in full. Another big thing to do would be, of course, just set up notifications, especially as you get a lot of different credit cards. Like, it was easy when I had just Chase cards, because I'm always in the Chase app, and now I have Chase, Citi, U.S. Bank, Huntington, Wells Fargo, you name it. So I'm not going to look at all those cards all the time. So I'll go into each one of them and say, hey, send me a notification as soon as the statement closes. something like that. That's the best way to do it. Now, again, let's talk about a few other things here, because what happens if you don't do this? What could make your APR go up? Because as we talked about earlier, again, it is going to be variable. Well, there's a few factors here that could affect that going up, some things you need to know about, as well as your rights as well. So here you have it, increasing APR factors, missed payments like we just talked about. Federal Reserve raises rates. Again, Federal Reserve has a kind of a federal funds rate that they control, and when that goes up, again, it kind of makes all short-term interest rates go up as well. And so that will definitely do it. Introductory offers expire, and then my favorite is because reasons. Because they can do it. Because the lender can do it at any time. It's in the terms and conditions. Now, there is a rule here, though. Issuers can't raise APRs on cards less than 1 year old. And you must be given written notice 45 days before the new APR goes into effect. Now, you can opt out of this change. The letter reads something to the effect of, these are your new change. These are like the new changes to your card member agreement or something like that. You don't have to do anything to opt in. However, if you want to opt out of them, well, that really means the card will be closed. Of course, you'll still be responsible for the balance, so it's kind of like, yes, you have a choice, but you don't really have a choice. Now, they do have to give you, 45 days notice, because, again, that new APR is going to affect your current credit card balance, so it gives you time to, like, oh, no, I should pay this off or find something, to make this work so I don't have to get hit with this new interest rate. So those are some things to know. Definitely know your rights there. Now, in addition to that, what if, you wanted to lower your APR? What goes up must come down. Well, hopefully. So let's take a look at this here. And if you wanted to lower it, well, again, there's introductory offers. Those are usually the best ones, right? So if you're going to, go and buy something that you need a little bit of extra time on, well, then all new cards come with 0% APR for X months deals. However, I would say that, there are certain cards like the Bank of America card, the white one from Bank of America, that one will last. That usually gives you a longer APR deals, because again, that's not a multiplier type card for earning. That's more of a balance transfer low APR card. But again, even something like a City Custom Cash, something like that, will still usually have 12 months 0% APR, very low APR, just to get you to use the card. In addition to that, there are promotional pricing offers that come out all the time. I get these a lot from American Express and things like that, and say, hey, look, we're running, not 0%, but like 3%, 4%, something like that, and it's almost based on, because they now know you as a customer, so they kind of know that you're a little bit less risky, so they're trying to entice you to use your card more. And of course, the last one here is you could simply ask. You can secure message, call your lender, something like that, and be like, hey, I'm trying to get a lower APR for whatever reason. Now, again, if you're doing this one, you're going to have some established credit history. If they've raised it in the past due to missed payments or something like that, you're going to have to put quite a bit of time in between that. Then you can definitely ask. It's possible they may want to do a hard pull on credit again to check credit worthiness. That is an option. Definitely ask about that and ask what their process is if you are requesting a lower APR. But overall, though, that is everything you need to know about credit card APRs and APRs in general. Again, this does apply to other APRs. It's just really we focus on credit cards. So again, overall, the moral of the story is now that we've seen the math, we know how it works. This is why it's best to avoid credit card interest. Again, there are tools out there. There's nothing wrong with taking advantage of those 0% intro APR offers. If you need to play the float a little bit, by all means, that's what they're there for. You really just got to treat them more like an 11-month loan instead of a 12-month loan to make sure it's all paid off. Again, balance transfer cards, also your friend here to get out of paying higher interest rates. So there's definitely some financial tools you can use. We have videos on all that stuff. I will link down below for you if you are interested. But anyways, guys, if you like this one, drop me a thumbs up down below. Of course, if you found it particularly interesting, consider subscribing to the channel. So again, posting content just like this every Monday, Wednesday, and Friday. Of course, right back here every Sunday with all the news you can use in the week that was in credit and finance. Again, my question for you guys is let me know down below, what are some of the best or worst APRs you've seen, as well as what are some of your tools that you use to take advantage of these 0% offers. How do you feel about those, 6 months, 12 months, same as cash? Love to get your thoughts on that. But anyways, guys, that's going to do it for this one. As always, thank you so much for watching. We'll talk to you very soon in the next one.